Hello and welcome to Quantum Advisory's Investment Markets Update. My name is Edvardas and today I will discuss the investment outlook and some of the investment considerations to be aware of. Before we dive in, let's look at how markets performed over the last year and the first couple of months this year. Looking at the graph on the left, we can see that 2024 was a very strong year for global equities, where the US and Japanese equities led the way. The US equities, of course, were the top performer and delivered around 25% for the past year, which is first back-to-back returns of over 20% since the mid-90s. Growth stocks and AI companies, such as Magnificent Seven, drove most of the US returns. In the Q4, we saw a story of Trump and his pro-business agenda, such as lower corporate taxes helping the US equities turn the year on a high note. In the UK, we saw a more modest equity returns due to its heavy weighting towards value-focused sectors, such as banking, industrials, and energy. In fixed income space, we saw bond yields increase significantly over 2024, which caused gilts, both nominal and linkers, to deliver negative returns. This was correlated to a rise in US bond yields due to the fiscal outlook under Trump. UK gilts were particularly impacted by the lower economic growth outlook for the UK and the lack of government's fiscal headroom in its autumn budget. Compared to fixed income, cash is king, performance is positive, and the magnitude of this is largely due to higher interest rates. If we look at the graph on the right, it shows us how the markets performed during the first 2 months of this year. Equities continued to rally since the quarter end, but UK and European equities outperformed the US so far this year. US equities were impacted when the news about DeepSeek, which claimed to have developed a more efficient and cheaper AI model, sent shockwaves through the technology sector, causing big US tech stocks to tumble. Essentially, we saw the Magnificent Seven stocks to become a sad seven. This highlights the fragility of the US markets at the moment. European equities, on the other hand, are doing pretty good this year, with significant gains in just a 2 months. And there are a couple of reasons behind this. We saw increased defense spending commitments by EU leaders after US distances itself from supporting Ukraine militarily. Since the middle of the month, the 5 biggest US defense stocks delivered a negative returns, whilst the top 5 of the European ones are up strongly. Secondly, the shift in investor focus due to the stagnation of major US stocks. EU equity index funds attracted a record inflow of capital in Q4 of last year, and the trend continued in 2025. This surge in defense spending also helped the UK equities to perform well since the start of this year. In addition, UK equities have been trading at a notable discount compared to other markets, particularly the United States. This valuation gap, combined with appealing dividend yields of around 4%, has attracted investors seeking value and income, contributing. Let's now look at the economic outlook. A soft landing is still the expected scenario according to the most economic forecasts. That said, inflation remains elevated and economies have showed signs of slowing. We saw inflation ticked up over the fourth quarter, and the latest readings in the UK and the US came in higher than expected in February, which resulted in gilt yields rising and a reassessment of rate cut expectations. Generally speaking, services and wage inflation remain elevated. In terms of economic growth, we've seen a general slowing, but this seems to have mostly impacted certain European countries such as Germany and the UK, but to a lesser extent. In light of higher than expected inflation, stagflation remains a risk in Europe. Bank of England has halved its growth outlook for this year from 1.5% to 0.75%. Geopolitical uncertainties certainly remain a threat to markets, such as ongoing conflicts between Russia and Ukraine, and now the US softening its approach to Russia and suspending military aid to Ukraine. This might push the EU to confiscate a chunk of frozen Russian assets to send aid to Ukraine. Any escalation in the conflict is a risk that could disrupt supply chains such as we've seen in 2022. Our outlook for the US equity market is positive in the short term, especially with Trump coming back and some of the measures that he wishes to implement, such as lower corporate taxes. However, company valuations and the US market concentration are very high by historic standards, which may make the US equity market vulnerable to shocks. You might be thinking already, what are the investment considerations in light of everything that we have discussed so far? Just to recap, we spoke about the US exceptionalism and how the US equity market outperformed its developed counterparts over the past 15 years, which was mostly driven by the Magnificent Seven technology companies. These companies have now become a relatively large weight of the global equity index and pose a significant concentration risk. A couple of options that investors could consider to mitigate this risk include diversification within equity, such as active management, rotation within the US market from technology to other sectors, or rotation to other regions, for example, UK or Europe. Another possible solution is to reduce reliance on equity beta and introduce manager skill-driven strategies such as hedge funds or private markets. Higher rate environment is another issue to be aware of. We've seen a widening in budget deficits in recent years, and this means that long-term interest rates are likely to remain high by historic standards. We have seen the UK gilt yields reached a 27-year high on the long end near the year end. A lot of this movement is correlated to the US Treasuries, as yields there have increased as well, but UK yields have increased more as our economy is stagnating and our inflationary issues are also a bit worse. In the recent autumn budget, the government left £10 billion of fiscal headroom, and due to no growth and higher cost of borrowing, there is no headroom left essentially. Therefore, if things worsen, whether it be high yields or continued stagnation in the economy, the government may need to raise taxes again or borrow more, which could exacerbate things further. So what do the high yields mean for pension schemes? Funding positions remain strong or have increased where the liability hedging isn't in place. This means that they could look to reduce leverage or increase hedge ratios. Finally, the higher rate environment could be good for multi-asset credit, as it may increase the opportunity set in that space, although credit spreads are historically low at the moment. Finally, let's talk about geopolitical uncertainty. The return of President Trump brings uncertainty due to the prospect of tariffs, where he has already imposed a 20% tariff on goods from China and 25% on Mexico and Canada. These measures could be inflationary during a time when inflation is already expected to remain a little higher than recent historic standards. In terms of investment considerations, diversification benefits of bonds diminish in inflationary scenarios, so we have suggested our clients to look at low beta and real assets, particularly assets with some form of inflation linkage, such as infrastructure or. Thank you for listening to Quantum Advisory's quarterly investment podcast. We hope this edition has been informative and provided you with an adequate update on the current economic climate. If you would like to discuss any of these topics raised in more detail, then please get in touch with your Quantum contact.